Good evening, Forex capital traders. This is your weekly market update with Ben Esler. There's my email address and the account manager's phone number. If you've got any questions, feel free to ask. The following education session is not to be treated as personal advice. Forex CT provides general advice only that does not take into account your objectives, financial situation, or needs. Trading FX and CFDs involves a substantial degree of risk and should only be undertaken with risk capital. Investors do not own or have rights to underlying assets. So we'll kick off with USD as usual. Fairly exciting week last week. Had loads of data come out, as you can see. Chicago PMIs, 58.9 was 60 expected. Still a very good number, though. 58.9 is a fairly impressive expansion there in the manufacturing sector. On the first, pending home sales was a good number. Personal consumption expenditure was a good number. Personal income was a bad number. Market manufacturing PMI was a very slight surprise to the upside. On the second, we got a lot of PMIs. PMIs, as I've explained before, are a leading indicator. So unlike GDP or non-farm payroll or a lot of these other things that tell us about what has happened, PMIs tell us about what's coming up. So on the second, ISM manufacturing PMIs were a good number, a very slight miss. Prices paid was quite high. ADP employment came out and was a bit of a miss. Which is often an indicator of what's going to happen with non-farm. It wasn't this time. On the third, we had market services PMI, so obviously as opposed to manufacturing, that gives us an idea of expansion, expected expansion within the services sector. And that's a good number too, and a surprise to the upside. Initial jobless claims was bang on again, slightly better than expected, but pretty much bang on. Been 240 now every month for a long time, every week, sorry, or in that ballpark. On the fourth, non-farm came out. And it was a good number. We got a surprise to the upside. The US dollar enjoyed it, so there was a bit of a surge down on the Aussie and the Euro and whatnot. A bit of a surge up across the board on the US dollar against a basket of other currencies. Average hourly earnings were good as well. So that's the key there. You want to see both of those things come in strong, and they did. Unemployment stayed right down at 4.3, which is a great number. This week, as a bit of a drought in terms of announcements coming out. CPI at the end of the week, obviously, which is a big one. But until then, non-farm productivity, traders will look to that, but not in a huge way. Again, initial jobless won't get much excitement out of the market at all. CPI, however, could. And Kashkari speaks as well. He's one of the members of the FMC, one of the voting members on interest rate hikes. So certainly we could get some movement out of that. If he's more dovish, they have been dovish recently. So if he's more hawkish, I expect we'd get more of a move than the other. Now I put this up just for just because I thought it was interesting. What we're looking at there, the chart below, is actually the weekly chart on the dollar index. Now it looks like a buy. It looks very oversold. It's just come back up through the bottom Bollinger on the weekly, and it's just bounced off 30 on the RSI. So technically, now look, obviously fundamentals can trump, which is a perfect word for right now, can trump the technicals. But looking at those technicals, it looks like the US dollar is just about ready for a big reversal. It's obviously been selling off all year. Peaked at the very end of 2016. We had a nice sell signal there where it's sort of come through the top of the Bollinger and come off 70 on the RSI and sold all the way down to now. And I think we're going to see buyers step in. I think at some point could be a little bit more downside potentially, but I'd much rather be buying the US dollar than selling it. Having a look at that weekly chart, unless of course Trump gets impeached, or there's certain things that could happen that would really blow this thing out of the water. But yeah, just I popped a weekly chart in there for a bit of a change because I thought it looked interesting. Now on the euro, on the 31st, good news on unemployment there. Still a shocking number. 9.1 is not great, but improving, heading in the right direction, which is good. CPI was a surprise to the upside too, so good news there for the euro. As you can see, obviously we had that sell-off on Friday on the back of non-farm, but apart from that, it was another strong week for the euro. And this doesn't look like it's, it doesn't look like it's given up yet. In contrast, obviously, to that weekly chart of the DXY. So the dollar index, if you didn't know, 60% of that is weighted towards Euro USD. Obviously, it's in reverse because it's US dollar. On the first, we had GDP come out, which was bang on expectation and good. Well, on a long-term scale, 2.1 is not good, but in recent history, it's quite good. Market manufacturing PMI came out pretty strong for the zone. 56.6 isn't a bad number. It's a slight miss, but still pretty solid. Services PMI came out on target and a good number. And retail sales was a good surprise, the upside there, 0.5% more than expected. So, the euro, it does look to be improving. It has been very strong, but it's also had a massive rally up. This is probably not got a lot left in it before we get a bit of a pullback. And looking at that weekly chart on the DXY and the dollar index there, I think it's probably not too far off from happening. Aussie dollar, on the first where the RBA rate decision and statement was dovish. They downgraded some forecasts and that sort of thing. And look, they were probably part of that was probably just jawboning. If you're not aware, jawboning is the process of talking a currency down. A lot of central bankers will talk their currency down. They don't want to cut rates. They don't want to instigate an easing program. They just really would like to have a lower valued currency because it'll support their exports and support their economy. And it was something that Glenn Stevens did religiously, was jawbone the Aussie. So Philip Lowe maybe taking up the mantle there. On the third, we had trade balance come in weak. So, that would, that's pretty bad for the Aussie dollar. So, we didn't really get much of a reaction. I mean, last week wasn't a great week for the Aussie, but certainly didn't get any meaningful sell-off. There was a bit of a dip on that non-farm, of course, dipped below 79 cents very briefly. There's probably going to be a sell-off at some point. Nothing goes straight up. Retail sales came in okay. On the 8th, we've got Chinese trade data. That's a big one for us. Chinese economic data will often affect our currency more than our own. On the 9th, Chinese CPI, again, that's a fairly significant announcement. The RBA's Assistant Governor Kent will speak on the 9th, and we'll get home loans and consumer confidence data, Westpac consumer confidence, that is. And then on the 10th, consumer inflation expectations. So that's all fairly important. If inflation remains low, then we're a long way from the RBA raising rates. I think, there's probably not going to be any cuts. Cuts seem to be off the table. Now we're sort of looking, and the market is looking at when the next hike's going to be. And I did actually read an article by an ex-member of the RBA who said that, if the global economy hits all the forecasts, so there's some fairly rosy forecasts out there for the Western developed nations going forward by the central bankers and the IMF and whatnot. If they're all hit, this chap was positing that we could be looking at 8 interest rate hikes over 2018 and 2019. I think he's probably right. If the global economy goes back to normal, these sort of rates that we've seen for so long now, it's just not the normal run of things, and the rates will have to go up to stop inflation and to stop housing bubbles and all these sort of things. Pound, another, it was quite an exciting week last week, actually. The pound got smashed on the back of the Bank of England rate decision. Now, the analysts were expecting that 2 members of that, of the voting council of 9 were going to vote for a hike. The previous meeting, they had 3 vote for a hike. So that was seen as a move towards, a little bit more of a hawkish stance. This time they definitely took it off the table, but I'm surprised the market reacted so violently because it was expected. The analysts were expecting 2 people to just vote for that hike, and that's what happened. Bank of England did lower growth and inflation forecasts going forward. They reduced their GDP forecast for this year and for next year by 0.1%. So bad news. Definitely a step towards the dovish column. And a step away from any sort of monetary tightening, and the market really reacted quite violently to that. We're looking at pound yen there, so a big sell-off, as you can see, several hundred pips in the day on that Bank of England rate decision. Obviously rates were on hold. Mortgage approvals came in, a very slight miss, but almost bang on. Consumer credit similar, bit of a miss, but not far. Market manufacturing PMIs were solid, a good number and a surprise to the upside. But yeah, dovish. Not much data this week for the pound either. There's really not much coming up, so it's going to be driven by by other countries' economic data this week. Does look it's sitting on support there. Potentially the pound yen could be a bit of a buy, but if you were going to do that, you'd sort of put a stop there below the that red line is the 50-day moving average. I'd be looking to have a stop below that. Okay, the yen. So on the third, we had foreign investment. Not much data for the yen. Dropped from the week prior, but not by a huge margin. On the 8th, we've got economy watches coming up, which is fairly closely watched. And on the 10th, foreign investment, again, a machinery order. So that'll give us a bit of a snapshot of what's going on. Not hugely exciting developments within Japan right now. Unemployment, inflation, everything seems to sort of sit pretty stagnant. The yen gets such big moves because of the safe haven. The way it's viewed as a safe haven currency. That's why you get such volatility. Often, you put any currency against the yen, it'll get more pips than it will against others. So, a bit of a rattlesnake. Look, this is obviously inversely correlated to gold as well, and based on that DXY weekly chart, maybe we're going to see some upside on this. Maybe it's about time, that the US dollar turned the corner. And certainly if we got a little bit of security out of the Trump administration or anything along those lines, that'd make it pretty easy to buy. But I'd be waiting to see how the week starts personally before I stepped into this market. Oil, pretty well traded sideways last week. We finally got a little bit of a disappointment on the crude oil stocks. So for the past couple of weeks, we've just seen massive drawdowns week in, week out, well above analyst expectations and consistently strong. This one, not the case. 1.5 million barrel drawdown, still a drawdown on stocks, but they were expecting about twice that. Baker Hughes rig count, interesting enough though, ticked down one, and that hasn't happened often for a long time. It's been steadily traipsing up. So maybe the shale guys are finally sort of stepping out due to that price sell-off. Interestingly enough, it seems like the sell-off is over now, and they start pulling back a little bit. So yeah, look, this is looking very strong. We've got an OPEC meeting now. I wouldn't be surprised if OPEC does something. Deepens their output cut or whatever, because it doesn't seem like this market will take a lot to go back up to 55. And if they can break that, every time it's on the way down, when it's at 42, you get all these analysts pile in and say, oh, it's going to $30 again, which is rubbish, in my opinion. All the shale guys can't get oil out profitably at those prices, or the vast majority, as to my knowledge. So if they pull out, output goes back down, has to go back up. So there's an equilibrium somewhere that's much higher than that. And there's a lot of political risk in a lot of these supplies. Nigeria and Libya, they're increasing output, and so they've hurt the OPEC output cut to an extent. And both of those places are basically in civil wars. It might not be full blown enough to call a civil war, but there's rebels. There's Boko Haram. There's a lot of stuff going on in these places that can threaten oil supply. So wouldn't take too much of that, and especially if we've got a little helping hand from OPEC with an output cut, deep in the output cut, or something of that nature. And we should see this continue to go up. Right now, again, it's sort of no man's land right now, but I'm definitely keen on buying dips. Looking forward to the 9th, we've got crude oil stocks again on the 11th, Baker Hughes rig count. So an announcement from OPEC could blow either of those out of the water in terms of market impact, though. But they'll have an effect, definitely. So wind up with gold as per usual. VIX was down 2.2% on Friday, and gold followed it down. So a good non-farm there, and a strengthening US dollar pulled it back a little bit. From here, technically it does look like it might have some downside. At this point, it's hard to say whether the leg up is over. There certainly could be one last little gasp, but if I had to do something right now, I'd sell it. Basically due to my opinion on the US dollar there coming back up. But a tough one to pick right now. As you can see, it sort of bounced off the top of that Bollinger. This is a daily chart we're looking at. And it has sort of floated up to the top of the RSI and started coming back down. So this could be the end of that. That could be the end of that leg up. We could be heading back down to 12.10 ballpark. Um, and if I had to do something, that's what I'd do. But I'd probably like to see a little bit more confirmation on that. All right, that's it for the week. Thanks for your time. I'll talk to you next Monday.